Welcome back to the Deep Dive. Today, we are tackling a really complex topic, but one that affects everyone, financial health. Specifically, we're looking at why people fail financially and what framework is needed to build, real long-term freedom. We've been looking at an interview with the author of New Kai, which translates to The Slave of Money. And the goal here isn't stock tips. It's to get right to the core wiring that determines whether you succeed or, well, collapse.
And that wiring, that structure is everything. The mission here is so important because, as the source points out, people almost always mistake the symptom for the disease. So this deep dive isn't about learning a new savings trick. It's about understanding the internal thinking models that lead people to ruin. The goal is to build the direction you need for long-term control. The author calls it purposeful freedom.
Okay, so let's get right into it. The first big question, what actually leads to something like bankruptcy? Because it's so easy to blame the outside world. We point to consumer culture, credit cards, buy now, pay later.
Right, the temptations.
Exactly. We blame the world for tempting us.
And that's what the source calls layer one, the surface layer. In the original, it's LS. But here's the key insight. All those things, the easy credit, the gig economy, the pressure to consume, they are not the original sin. They're just tools. Very powerful tools, for sure, but still just tools.
Okay, so the interesting thing isn't the tools themselves, but what they do to our perception. They seem to be incredibly good at one thing, hiding the true cost of something.
That's it. They take a big, painful number and just chop it up into these small, seemingly harmless monthly payments.
And that's where the mistake happens. People think, well, if I can afford the monthly payment, I can afford the lifestyle.
Exactly. That assumption is the entire trap of layer one. You might afford the payment this month, maybe even for a year. But the real question is whether your entire life's cash flow can actually sustain it. And layer one makes it impossible to see that.
Which I assume brings us to layer two, the deep layer, or toe. So if layer one is the tools, layer two has to be the internal operating system, right? The mindset using those tools.
It is. It's a fundamentally flawed mindset. And bankruptcy, according to this model, is never a single event. It's not one bad decision. It's the end result of making dozens of decisions that all seem perfectly reasonable in the moment, but they're fundamentally wrong because they're all based on this broken internal model.
So what are the actual flaws in that model? The source lists 4, and I think walking through them is key to understanding the structure here.
Okay, so the first one is a fragmented understanding of cash flow. This is the person who's always thinking, I can always earn more later, so it's okay to run a deficit now.
Constantly solving today's problem with tomorrow's imaginary money.
Precisely. They don't see their financial life as one continuous system.
And that must be made so much worse by the gig economy, where earning more later feels really plausible until it isn't.
Which leads right into the second flaw, and this one is maybe the most dangerous combination. It's having an unstable income paired with fixed debt. Your income is up and down, unpredictable. But your rent, your car payment, your loan installments, they are perfectly predictable. They never miss a due date.
It's like a structural time bomb. You're just waiting for a low-income month to line up with a high-payment week.
And the system breaks. It's a trap designed by layer one tools sitting right on top of this layer two flaw.
So it's not the debt itself, it's the mismatch, the lack of sync between your income and your outgoings.
Exactly. The third flaw is, well, it's a complete lack of respect for the compounding effect, specifically the compounding effect of debt.
We all love to talk about compound interest for our savings, but we forget it works the other way.
And it works with a vengeance. People treat their credit card bill like it's a one-time fee, not this monster that's growing in the background, quietly, until it's suddenly too big to handle.
Okay, so what's the fourth and final piece of this deep layer failure?
It's mistaking short-term comfort for long-term sustainability. This is the emotional part. You take the bigger apartment or the vacation, not because it fits into your long-term plan, but because it feels good right now.
It provides immediate relief.
It does. You're trading future stability for present moment comfort over and over again until you have no future stability left.
Wow. When you lay it out like that, it completely reframes bankruptcy. It's not a heart attack. It's a chronic disease. It's death by 1,000 reasonable little cuts.
And it all comes back to this core analogy the author uses, snorkeling. Financial clarity, they say, is like cash flow visibility.
Okay.
If the water is murky full of hidden fees, interest, confusing payment schedules, you can't possibly make good long-term decisions. You're just thrashing around.
But if the water's clear, you can see the path forward.
Exactly. Clarity is everything.
Okay, so if the goal is clear water, we have to ask why it gets so murky for some people and not others. The sources move beyond just saying people have weak financial awareness. Instead, they point to two fundamental human barriers. What are they?
They are ego and the blind spot. And the first one, ego, is just a massive psychological hurdle. Ego is what stops someone from learning basic, unsexy things like how to make a budget.
Because it feels remedial, right? Like admitting you don't know something you're supposed to know.
It feels beneath them. Ego makes people use consumption as a stand-in for identity. They have to drive a certain car or live in a certain place to project success.
They're confusing looking successful with being successful.
And that is an expensive confusion to have. That facade, that need to look good on the surface layer, is actively destroying the foundation on the deep layer.
That's a really powerful link. Okay, so what's the second barrier, the blind spot?
Right, the blind spot. And this isn't about laziness. It's a failure of imagination. It's the inability to clearly see and plan for your future self, say 5 or 10 years down the line.
So is that just, oh, that's future me's problem, or is it a genuine inability to even picture what those problems might be?
It's more the latter. And it's driven by a huge gap in our education. Schools and families, they just don't teach how your financial life evolves. They don't teach you how risk compounds over time, or, and this is crucial, how small daily habits slowly lock you into major life choices.
Can you give an example of that?
Sure. A simple habit like eating lunch out every day for $100 isn't just a $100 decision. That habit forces you to work near expensive food places, which dictates your commute, which might dictate your rent. It all cascades.
So financial problems aren't sudden. They're just the bill coming due for years of invisible choices.
Choices you made because your future self was in a blind spot.
So if you put it all together,
Yeah.
the flawed deep layer, the ego, the blind spot, what's the single biggest mistake someone listening might be making?
It's that they lack a map. The author calls it a financial freedom template. Without a map, you end up mistaking speed for direction. You mistake luck for ability. And worst of all, you mistake emotion for judgment.
So you get a big bonus, that's speed,
Yeah.
but you have no idea where to go, so you just spend it.
Exactly. The whole point of a book like Nukai is to give you that map, that structure.
This really shifts the focus, doesn't it?
Yeah.
It's not about what to do, it's about how to think. It's principles before tactics. So the source says advice should come in 2 steps before any techniques. What's step 1?
Step 1, establish your financial values. This is the bedrock. Your values define what you're trying to protect when things get tough. Is it security? Is it freedom? Is it keeping up with others?
That seems almost philosophical. Why start there instead of, say, with a savings account?
Because if you don't know your why, every financial tool just becomes another source of stress. If your core value is comparison driven by ego, you'll always overspend, no matter what your budget says. Your values are the filter for every decision you make.
Okay, so once you know what you're protecting, what's next? What are the actual rules of the road?
Step 2, build financial principles. And these aren't just tips, they're rigid guiding rules that don't change. The author gives 3 really good examples. The first is, survive first, invest later. This means your emergency fund, your insurance, your absolute base level security. That has to be solid before you even think about chasing stock market returns.
That makes perfect sense. It's a direct counter to that fragile, unstable income plus fixed debt problem.
It is. The second principle is, a little counterintuitive, it's cash flow prioritizes returns.
Wait, okay, help us understand that.
Yeah.
Isn't the whole game about getting the highest return possible?
That's the common wisdom, but it's often wrong. The source argues that strong, positive cash flow gives you something far more valuable than a few extra percentage points. It gives you optionality, resilience.
The freedom to choose.
Yes. If you have extra cash every month, you can wait for better opportunities, you can pivot your career, you can survive a downturn. If all your money is tied up chasing returns, you're actually very fragile.
So cash flow is the engine and returns are just the throttle.
That's a great way to put it. And the third principle is, only take risks you can see. This goes back to the snorkeling analogy. If the water is murky, if you can't clearly map out what could go wrong, you just don't do it.
It protects you from gambling based on hope.
Exactly. It stops you from mistaking luck for skill.
The real insight there is that principles are what protect you when visibility is low. They give you direction in the fog.
That's it. And according to this framework, that's what real financial awareness is. It's not a number in your bank account. It's a compass that keeps you pointed in the right direction.
Okay, let's talk to the person listening right now who is may be in trouble. They recognize these flaws in themselves. The gut instinct is to just work harder, earn more. But the source says the very first step is something else entirely.
The first step is absolutely not earning more. It's stopping the bleeding. Because if you just pour more money into a broken system, the system will just burn through it faster. You're accelerating the collapse.
And stopping the bleeding means two specific things.
Yes. First, you have to stop the self-deception. No more, it's just temporary, or my next bonus will fix this. You have to be brutally honest about the hole you're in.
And second,
Second, you immediately rebuild cash flow discipline. That means cutting fixed expenses, restructuring debt, whatever it takes. The goal is to make getting through the month a controllable, predictable thing again, no matter how modest that looks.
this is the sinking boat analogy. You don't try to speed up. You find the leak and you plug it.
You plug the leak first, always.
Yeah.
Only then can you even think about sailing faster. And if we tie all this together, what's the big picture? Why does this matter so much? The end goal isn't money. It's what the author calls purposeful freedom. A life where your time is governed by your own values, not by your monthly payments.
And that freedom comes from structure, not just from a high salary. It's about recognizing what your life stage requires. Young people need discipline and positive cash flow. Later on, you might need more liquidity and optionality. If you apply the wrong principle at the wrong time, it won't work. There's a final takeaway from the author of New Kai that I think really brings this home for the listener. They write about how people ask them how they have time for family and travel and writing. And the answer isn't that they earn the most money. It's that they built a system where they do not need to exchange all their time for income. And that decoupling of time from income, that's the ultimate freedom.
Which leaves a really important question for you, listening right now. What stands out to you in all this? Is your financial life still being run by that deep layer thinking? Are you still making those reasonable but wrong choices? Or have you started to build a structure based on clear values and principles?
Because if you use the framework from this deep dive, you realize financial control isn't really about saving more. It's about having a clear direction.
So here's the final thought. What single habit right now is locking your life choices? And what could you change about it to increase your financial visibility, to clear that snorkeling water over the next 5 years? We hope this deep dive helps you find that direction.